Welcome, everybody, to Charts and Chats with me, Gordon Scott, and with you. Glad you're here today. We got some really interesting things to share. Most importantly, what do you do or how do you set up a trade that can make you money even if you're wrong about what that trade and what's going to actually happen? I want to cover that today, but first, let's get straight into what's going on over the weekend and how the US markets are set to open up probably a little higher this morning. So, what we're seeing here on the chart behind me is the NASDAQ in the blue line. I decided to do a line chart today, keep it real simple. And the yellow line is the Aussie yen, right? So, this Aussie yen, the reason we watch the Aussie yen is that it's a global or a proxy for global attitude towards taking risk. The higher it goes, the more interested people all over the world are interested, the more interested they are in taking on risky trades or looking for big opportunities, right? And then the NASDAQ, which is 75% correlated to it, what is it doing? Is it doing the same thing? If it is, then markets are moving the way they do most of the time. If they're doing something different, we want to pay attention to that. In this case, however, they're both moving generally higher. Here's the weekend right here. This is, from Friday to early Sunday morning in depending on what time zone you're in, right? So it jumped up, and since then it has drifted higher. Aussie yen, a lot of fluctuation, but again, drifted higher. In fact, in the most recent half hour or so, Aussie yen has been moving up. So this is just generally an optimistic start. Mondays, of course, quiet day to open the U.S. markets, but it looks like this is telling us things are optimistic. So if we have an optimistic day, then you're generally going to want to think about being a buyer. I'm going to show you a few charts that might be interesting buy opportunities. Okay, so let me see if I can share my chart, and we'll get into direct screen sharing mode. Here we go. All right. So hopefully you can see that. If you cannot see the H&R Block chart, then you'll want to chat in and let me know. But for now, it looks like we're okay. All right. So the first chart I want to show you here is H&R Block. Is this a good stock to buy? Well, maybe for one day. Let me show you. There is a really interesting website that I've been using for quite a while to look for both stock and option ideas. I mean, I think I've talked about FinViz, FINVIZ, before on my show, but the other site that I have been using for months is Market Chameleon. And the guys at Market Chameleon, I had a chance to chat with Dimitri. He's one of the two main guys there that talks about the site. If you go like on YouTube and stuff and look them up, and I had a chance to talk with Dimitri a couple of times over the past weeks, and great guys. They got a great product. Really like what they're doing there, and Dimitri put me on their list just so that I could be evaluating what some of their option trade ideas are. And they sent one out just this morning that I thought was really good. I wanted to share it with you, and that is this one, H&R Block. So their ideas come in a kind of an email because what they do is they base it on earnings that are upcoming. So these are option trades that happen on earnings, and this is the diagonal call spread just a couple of days before earnings. Now, literally what you do is you put it on the day before earnings, and then the day, excuse me, sorry about it, the day of earnings, you close it out. So in this case, it would be you buy today, sometime early in the session, and then you sell it tomorrow, anytime, but likely later in the session. Let me see. Let me make sure I'm not steering you wrong on that, because that might be is that a before the market opens um, or after it closes? I thought H&R Block was a BMO, but in any event, basically it's a 1 day trade. That's what you'd be doing. Now, H&R Block, this is a company that prepares taxes for other people. They're good at it. It's been tax season over the past quarter. Uh, Tax day was delayed by a month, and this right here represents like the day before. Is that one? Yeah, this one right here. This is essentially, well, that was the day that people had to file their taxes. Well, you see, a lot of people are buying this stock because they're looking around at how many people are, waiting to the last minute. Anyway, um, so I think they did well. They got a lot of customers, and that's what's going on here is that the anticipation that, wow, they're going to have good earnings, right? So people are thinking that H&R Block's going to come out with a good earnings report. The thing is, if you go back in history, H&R Block doesn't usually have a good quarter for the stock price anyway. The quarter after tax day, tax preparation day. That's largely because they do a ton of business, coming right up to tax day, and then they do less a little bit later. And it's not so much that they don't make money. I mean, they know how to manage that whole seasonal structure of their business. That's not the issue. The issue is people buy the stock in anticipation. And it's like that old Homer Simpson show where Homer buys pumpkin futures leading up to Halloween, but he holds on to them too long or whatever. Anyway, it's silly. But the idea there is people know about an event that's coming up, and so they anticipate it by buying up, in this case, shares of the tax preparation company leading up to tax day. So the stock gets a bit overvalued through this period of time, historically, year after year. Now, we don't know what's going to happen. We don't know that the stock's going to come down. We do know that people are probably paying a bit more for the stock than they would otherwise. Uh, but are they paying more for the options than usual? So the idea that Market Chameleon came up with is do a diagonal call spread where you sell at the money and then you buy out of the money. Now, it's always a trick to try to figure out, what is the way to get a good options uh, play, a good options opportunity. You have to look for something that people in general haven't overpriced, or they have overpriced. I mean, depending on you're making a bet depending on how much people have already made the bet, right? Sort of a second degree thinking. Anyway, in this case, what we know is that H&R Block has had the price run up from $22 up to $26 here just in the last month or so, and they're about to release earnings associated with this big quarter they had. So likely people are going to sell the news. I mean, they've been doing that all this quarter. Every major company, great news, and the shares sell off. That happens because people want to take profits. Institutions want to take profits. So, is it possible that people would want to do that here? Yes, yes, very possible. But one of the things I like to do to find out exactly where the opportunity is for trying to play in options on this is to use this particular chart study I've created in um, TradingView, which gives me a look at both historical and implied volatility. Now, implied volatility is just the relative pricing of options, how much options are priced so that it tells you how much people think the price is going to move. All right. Um, if, on the other hand, you compare that with historical volatility, then you can get a nice look at what is price really doing compared to what people are anticipating it's going to do with options. So this idea that came from Market Chameleon was just buy a diagonal spread so that you can collect a high option price that people are expecting coming into earnings, and sell something further out that's cheap, and then let the option uh, uh, um, premium, sorry, melt into your favor. So how does that work? Yeah, I'm kind of moving a little fast in this explanation, but hopefully you'll be able to stick with me. So back to historical volatility. Historical volatility is all these bands. All right. Now, what I've noticed with these Keltner channel bands is that when you have um, uh, a price that has moved into that top level there, the third band, the first day that it moves in there, that it closes up at that line, which was Friday for H&R Block, um, the next 20 days are bullish. That's you have a high probability. Now, this is right in front of earnings. I don't know. I wouldn't feel comfortable just straight up buying that, like buying shares in H&R Block right now. I would feel comfortable if, in fact, this thing dipped really low and seems to sort of make a rebound. Then buying in with the anticipation of that rebound. That sounds really interesting to me, but that's not today, right? Um, what if I were wrong about that, though? What if I were to wait and that dip never came and it just took off? What if I were right about it? Is there a way I could make a trade where I could win regardless of whether I was right or wrong? The answer is yes. And that's why I got so excited when I saw that this idea to try to make a trade on H&R Block from the options chameleon, or for the market chameleon guys. Their option idea is a perfect setup for how to be wrong but still make money, or be right and still make money. So I'll walk you through what the exact trade is, but before I do, let me show you how my technical study fits with what they're talking about, or is going to enhance what they're talking about. So here, what I've noticed is I've got these ATR, average true range. That's what the Keltner channels are. They're based on average true range. And this is the average point, and then one line above it is one ATR, two ATR, three ATR, right? So if you're looking at that, and we're seeing this thing's broke a brand new high, um, where's the next place it's going to hit resistance? The answer is this 4 ATR exponential in the 10-day. So it moves a lot more. When it stretches out like this and comes back, that high point, that's going to be resistance up ahead. So that resistance is sitting right there at around 26.75 or so. And the price closed at 26.19. So it doesn't have to move very far before it's going to hit resistance. Earnings are going to come. Yeah, it could jump and go through, but there's a real good chance actually what's going to happen is it's going to go up, it's going to hit that resistance and kind of come back down a little bit, at least a little bit, maybe more. So, I mean, I like this idea as, hey, this is bullish, but it's going to struggle trying to get too much higher. Now that's the historical volatility look, the price action. And the implied volatility is down here. This is really interesting. Usually what happens is as you run into earnings, you're increasing in options over the course of 2 or 3 weeks. Here, we've been declining. Well, that's largely because see these huge candles, and then all of a sudden we went to small candles. That wasn't just in H&R Block. That was many stocks throughout the market have been doing that. And in the case of H&R Block, uh, what that has led to is higher relative option prices that have started to drop down, and they are now very low comparatively. That's a great time to be a buyer of options right in front of earnings with options low, because that means as people come in to buy more options right in front of earnings, those prices, those relative option prices, are going to increase. So you like that. So this really helps out the idea. And the idea, once again, is that we want to sell an at the money trade and buy an out of the money trade. option. Let's look at how that might work in terms of the actual option strikes themselves. Okay, so here I'm going to look at this um, data from Thinkorswim. Now, this is based on Friday's close, so we don't really have excellent numbers for what they're going to be, because after all, H&R Block closed at 26.19. We can see here that the current bid and ask is 25 by 49. What that means is that somewhere in between that number, probably closer to 25, is where the stock's going to open up. So it is going to open up a little bit higher. Well, that fits with what we saw before, the Aussie yen and Nasdaq charts, right? So what we're going to do is look for a way to try and buy a option that's further out but that's low priced, and then sell an option that's closer in, so that we can get the benefit of, because what happens is when options um, option prices, when earnings come out, option prices tend to collapse. They call it the volatility crush. And so it's things that are sold at higher levels, become uh, less uh, valuable, less expensive. So here's one right here that I like. A 26. This is the at the money call. This is the option that is closest to the current price. So the price is 26.19. That's where it closed. That's what this price is based on. And there's an ask price of 90 cents to buy it, or it can be sold for 75 cents. Now, when this thing opens a little higher, then that bid will probably go up. So my guess is that you'd be able to sell this thing for 80 cents credit, or collect 80 cents for that option. This is the June option that expires this coming Friday. Only 4 days, 4 or 5 days. I mean, 5 if you count the day, right? Because it hasn't opened yet. Anyway, it's going to expire on Friday. We're not going to hold it until expiration. We're going to sell it. We're going to close the trade out before then, but we wouldn't even have to. Depending on how it plays out, we could just let it expire worthless. And so what will happen is that we're going to be able to collect something like 80 cents. Now, I'm looking at H&R Block, and I'm going to say, I think that is going to drop. I think it's going to go down. But if it goes up, I want to be right about that too, right? How can I make money if it goes up, or if it goes down? Either way, right? All right. So here's what we do. It said sell this one and then buy one that's further out. So the next one out is 32 days, a month away. And I could go, see, this is important. Look close at this options chain. If you look here and you see the further out of the money you go, the cheaper you would expect to get. The problem is you get right down to here at 31 strike, the strike price being 31, and you're paying 35 cents, but the 30 is only 20 cents, right? Why did this all of a sudden get so much more expensive? Look at the difference between the bid and the ask. 10 cents and 20 cents. There's 10-cent spread in between the two, and this one has a 30-cent spread in between. Why is that? The answer is over here in open interest. Open interest is 0. Nobody's in that trade. Nobody has an option sitting there on the 31. So the market maker is like, well, if I get in this trade, if I sell something if I sell this 31 option to somebody, I'm the other one who's going to stay. I'm not going to be able to hand it off to another market participant. I'm the one who has to sit in that trade. And if I'm right, great. I collect, 10 cents or 5 cents or whatever. But if I'm wrong, I'm going to get soaked. I could be paying dollars, and I don't want to do that. So I'm not going to just sell this for nothing. I'm going to make this fat 30-cent spread so that every single one of these, I'm going to make $30 for every contract. Somebody wants to buy 10 of these contracts on me, great. They're going to pay me $300. If they make 3,000 off of me, well, so be it. But that's going to happen so rarely. I'm going to at least be able to, every time I do this, I'm going to collect $300. Hopefully 1 out of 10 times is all I'm going to have to pay out, right? That's their thinking. That's the way they approach this. Anyway, the main point is there's no open interest. So look for something that has a tighter spread. Well, I wouldn't touch anything out of this. See, this is a 10 cent spread way out here. So that could work. This one actually could work. But this one is a 30 and 40 cent spread. And so like if I really wanted to get into this option and get out of this option, that's the one I would go with. But actually the best one is the 30 strike. Here's why. Because if I buy this, I have to pay 20 cents, right? But how much money am I going to collect if the thing goes the way I want it to? I'm going to collect 80. I mean, not if it goes away, just to initiate the trade. I'm going to collect 80 cents. So if I collect 80 cents and I only pay out 20 cents and the trade goes to nothing, what do I got? I got plus 60 cents. Now, the worst case that could happen is that the price ends up somewhere in between 26 and 30 in between now and the next 3 or 4 days. Well, what happens there? Yeah, I could get the stock assigned to me, and I would have to have this option to cover it, and so then I would lose out. An easy thing to do there is just simply buy 2 of these, right? So you get assigned the one, but you still got another one. You can wait, and if it goes up, you win. So the way to look at this, though, let me show you how this would come out. If I were to do a buy on July, but make it a 30 strike, and I would sell the 26. See there, it tells me I'm going to get 67 cents credit on that. Now, I'm probably only going to be able to get like 60 cents because 67 is just like, that's the average price. And I'm going to have to give them a little bit in order to be able to get them to get the market makers to take the trade from me. So if I come down here, for sure, I will get 60 cents. I could probably get a little more, but for sure I could get that 60 cents credit. All that has to happen for me to collect that 60 cents credit is that H&R Block closes below $26 on Friday, right? Okay, so that's the setup. That's kind of nice. It's just a 60 cents credit, and all it has to do is go down that much right there. Sometime in the next, or by expiration, right? However, you can do even better than that. Imagine that this thing goes up because the news is good, but it hits resistance and then comes back down. You've got 3 or 4 days to make that happen. At any one of those days where that happens, that 80-cent credit is going to shrink, and you might be able to get out with. In fact, that's actually the strategy that this idea is based on. It's not hold it all the way till it expires. Although if it drops, then yeah, you're going to get the expiration. But notice that this trade. So this is kind of an interesting thing. I don't take this as a it's guaranteed money. But what they're showing us here is that they did kind of a back test over the past 12 quarters and said, look, if you tried to do this the last 12 times that the H&R Block did earnings, what would be your win rate? The win rate is 100%. This particular trade setup has never lost. Now, they don't wait until all the way to expiration. What they do is 2 days before the day of earnings and then the day of earnings. So in other words, they'd put the trade on today, they would take it off tomorrow. And on average, it would make 21% over the past 12 quarters. So what would that look like? Well, that's pretty easy. We're looking at that 60-cent credit, and we're going to make 20 cents on that, or 20% on that. So we get the 60-cent credit, and then tomorrow it's lower. The credit is lower because this option is going to decrease in price. That where is it? I got to open that back up again. This one that is sitting at 75 by 90, right? That's going to decrease in price, and um, you're going to sell it, so it's going to you're short, right? You sell it at 80 cents, it drops down to 60 cents, say, then you could sell it back. Maybe the one that was 20 goes up to 25, but you still collect 15 cents. And 15 cents, what's that? Well, that's the average move that they would anticipate, or that has been made over the past 12 quarters. 100% of the past 12 quarters. I don't think it's 100% guaranteed trade, but I do think it's probably an 80%, 75, 80% probability that you would win that trade just the way they'd set that up. So I was really impressed with that. But I also know that, hey, you could be wrong, right? What happens? Well, there's a couple of scenarios. One, it happens just like this, just like I was anticipating that um, the earnings come out and people are like, oh, sell the news, and it price drops. Well, that's fantastic because then that 80-cent credit's going to drop down to whatever. The other one was only 20 cents. You can only lose 20 cents at the most. Um, so any amount of downward movement on the price, a little or a lot, is going to benefit you. Going to win with that trade, and that's if you carry it on and hold it over earnings, right? The other possibility is you put it on today, and then the next day you take it off before earnings are announced at the close of the market, um, and price goes up, but the option prices are going up even more. So you buy this thing and you sell it more expensively, right? So you would either way you would be able to win that trade. Well, here's what could go wrong, really wrong. It could be that the earnings news is great and people want to buy it. And so then you got this $26 stock or $26 option, and it jumps up to, let's say, 27.50, way up there, right? 27.50. And it opens. What's, what are you going to do then? Well, the short one, I mean, the one that's going to expire on Friday, that $26 option, you're going to have to buy it back, and you'd have to make a loss at that. So that's what could go wrong. If in fact you made that loss, it would be offset by how much gain you could be making from the out of money option that you bought, the $30 strike price. Now, to minimize that risk, you could buy the $28 option. That's what I was saying was closer, right? Because you buy 40 cents on that one. Well, we'll just do this here. See, now that one's only going to give you a 10-cent credit. No, no, no. Sorry, I did the wrong one. 26 I'm selling there. 28 I'm buying. There we go. Oh, okay. Still pretty good. 47-cent credit. That's really good. Why am I geeking out about it? Well, because if I were to bring that down to, mm, we could probably get 42. Worst case scenario, we'd have to pay 40, but surely we could get 40. We'd probably get 42. Um, if we could get a 40-cent credit on that, uh, and the price jumps up, then this $28 strike price, which is 40 cents, that's now going to be like 70 cents or something. If it goes up to 27.50, that thing's now going to be a 70-cent option. So you're going to make money on that. Um, and so even if you lose money where you have to buy back the 26 so that you don't get assigned or whatever, then that $28 call is going to offset your loss. So, and then you hold on and hope that it keeps going up. That would definitely be a way to reduce your risk. There's also the chance that because all you got to do is get from a 40-cent credit to a 30-cent credit, right? Um, so anyway, both of those setups actually look good. Buying the $28 or to $26, no, sorry, buying either the 28 or the $30 call and selling the $26 call against it. That's for H&R Block. All right. I hope that wasn't too complicated of a trade. I keep hoping that I get this opportunity to teach an options strategy class for short-term liquid options. This would be the kind of thing, these diagonal spreads, that's my favorite trade. This would be the kind of thing that you'd want to do. All right, so I don't think we have to worry about getting assigned because of this resistance level. I think that the price, even if it goes up, it's going to come back down. That's why I think that it's a high probability trade, and historically it has been a high probability trade too. Okay. If that was a little confusing and you have questions about it, please let me know. I'd be happy to try and get really simple with it. But I'm going to do another one here. This is Lennar, and that's the next one in their list. Lennar is a home building company. Lennar has gone up in the US. Lennar has gone up in price and come back down in price in concert with the move in lumber. By the way, if you probably heard a lot about lumber futures and lumber price action and stuff. If you're looking for a way to be able to track the price of lumber, here's the stock you track it with. Wood. There's another one called Cut, but they're both ETFs which kind of follow the price of lumber. And as you can see, this is actually timber and forestry, so it's kind of a little further upstream than lumber you buy in a store. And this one similar is Cut, but another one that really is the price of lumber these days, tracking the price of lumber these days, is Home Depot. You see how similar Home Depot and those other ETFs, Cut and so forth, look, right? They come up and then they sort of drift lower. Now, if I were to show you the lumber futures, that's LL, which you can actually, no, it's not LL. Sorry, that's Lumber Liquidators, LBS, like pounds, right? LBS. There's the lumber futures specifically. And you can see that this looks a little more dramatic in its price rise and fall than all those other ones that I've been showing you. And where's it going? It's cutting new lows. It's heading down even lower. So really strong indication that the whole lumber constraint price, pinch is over, and not just lumber, but everything. So we've been experiencing inflation in the U.S. and throughout the world, really, on a lot of commodities. And that's actually something that happens late in the business cycle. Of course, this is all done. This is all an artifact of the pandemic stuff, and the markets just having to adjust and kind of work their way through. But really, the drop, the super increase in lumber, and now the big drop in price in lumber, it's not just lumber, it's everything. Everything is coming back online. Everything is getting back into production, and the overall demand hasn't gone away, but the supply is not nearly as constrained. And so there's a good chance you're going to see prices drop in various things over the next, couple of months. And that's not a bad thing, but you want to be careful. Don't rush out and pay top dollar for stuff right now. It's tempting because you think, what if prices are going to get even higher? Maybe I can buy it now and sell it even higher still. No, no, no. We're in. Look at that chart. We are in mania state right now, and the mania is starting to come off. Don't be silly and go buying a bunch of stuff, at the high. And some people, in fact, over the weekend, I saw this like lumber divided by gold. Um, this is the lumber to gold ratio, some would call it. And look how it looks. Well, it looks a lot like lumber, but what this person's thesis is, hey, when you see this, look at that huge head and shoulders pattern, right? That we just broke through. When you see this kind of thing, the lumber to gold ratio make a massive reversal and come down. That's really bad for speculation money. It's a proxy for speculation. It's kind of what I do with the Aussie yen, but on a more because lumber is everything about lumber is really speculation if you think about it. It's like why are you buying lumber? Well, because I want to build a house. Why are you building a house? Well, because I want to sell it to somebody, or maybe I want it for myself. Why are you doing that now in the middle of all this? Well, because either A, I really need it, or more importantly, and this is most of the case most of the time, because I think I can make money doing it. I'm going to buy a house, I'm going to buy lumber, I'm going to build a house, I'm going to sell it because house prices are crazy high right now and they're going to get higher. Okay. If that's my thinking, then I'm fine with buying lumber. But when I'm doing it, even if it's a high price, but when I'm doing that, I'm speculating. See what I mean? Somehow I went out there and I either borrowed or I had money, but I'm putting that money into speculation. And so this guy was, I think, smartly pointing out that lumber is this hugely speculative asset. Gold, on the other hand, although it can be speculative, people tend to buy and hold gold forever with the idea that it's my hedge against inflation. And wow, we're having inflation like nothing else right now. So uh, if you have lumber speculation compared to gold hedge against inflation, and inflation happens because of, well, among other things, speculation, then this is a good ratio for whether you got too much going on, too much speculation, too much price increase, and the possibility of the bubble popping, right? So this person points out because this is happening, it could be really bad for, yeah, Bitcoin and all cryptocurrency. The whole cryptocurrency market might be this huge speculative bubble and it could really collapse. I thought that was an interesting hypothesis. The problem with it comes down to whether or not people are buying Bitcoin out of speculation or buying Bitcoin because they prefer a cryptocurrency, especially Bitcoin, compared to gold. Is cryptocurrency a better store of value than gold? The Winklevoss twins, billionaires now because of their bet on Bitcoin, believe entirely in cryptocurrency as a store of value, not as a speculation. And so they make that case like gold 2.0. That's what they call Bitcoin. Bitcoin is gold 2.0. So if they believe that it in fact is a store of value driving behavior, a store of value behavior is I'm going to put my money there and I'm just not going to look. I'm going to not care whether it goes up or down because I want to have my money there and I want to own that. That's actually the way a lot of cryptocurrency, especially Bitcoin buyers, behave. You know, hodling, right? Hold on for dear life. That's not what it actually meant. It's hold misspelled, but whatever. It's that behavior. I'm going to buy and I'm going to hold. I'm never going to sell. And that's actually the way a lot of those guys play. And so if in fact they are doing that, that's not a speculation. That means this hypothesis of wow, it's all going to crack and come down is not going to play out. Okay. So that's an interesting dichotomy. We had a question here. Let me see if I can get to the chat window so I can see what the question is. Looking for it. Chat window. Ah, here. No? Okay. Hey, Mai, if you can see that question and could repost it somewhere here into the chat window, I'm not. I saw it flash by that there was a question. Oh, no, I think it was a raise of the hand. All right. So if you have a question and if you're raising your hand, go ahead and type the question into the chat window if you want. Can you do that? If yeah, anyway, all right. I'll hope that you can get that question in there. Happy to answer questions along the way. So this is really interesting then. Are we going to see price come down? Are we going to see speculation taper off? Is the fact that speculation's tapering off possibly going to hit the Bitcoin world? Well, I'll talk about that in just a second if I can get to it. I think that there's another more interesting possibility. But back to the home building company, Lennar. So Lennar is one of the ideas here, and the idea was specifically LEN stock 3 days before to 1 day before. So this is just 2 days credit put spread. So I, basically, what you if you sell a naked put, so if you buy puts, you're looking for the price to go down. If you sell puts, you're interested in being the person who says, "Sure, I'll sell you a put because I think it's going up." That means I'm just going to keep the money that you give me for selling you a put option. So a credit put spread is the idea that I want to sell you some puts, but I don't want to take unlimited risk, because if all of a sudden the bottom drops out, and the price goes way down, well then yeah, I'm the one who that put option buyer profits from. So I don't want to be that. I want to protect myself. I want to sell the put, and then I want to buy another put lower down. I really like that idea for Lennar. Lennar is, yeah, that's the price. Sitting here at around $91. It has dropped down from 109, so that's a rather substantial drop. But this stock tends to move all over the place. And then what do the options look like on Lennar right now? Well, as of Friday close, they look like this. I could sell a 93 strike for $2.40. So I can collect $2.40 credit on a at the money put option. That's not bad. If I thought it was going to go straight up, I'd love that, because that means I'm going to get all of the 240. But that's not the idea that they had in mind. They had the idea. Uh, let's see, short 50, long 25. How could they do that? That's way. Are they even offering that? Short 50 put, long 25 put. Let's see if they have. See, they do have a 50 put, but you can't collect any credit from it. So I'm not exactly sure how that idea would play out. But let's follow the template. We're going to look at what we can get a credit for, and we're also going to look at what the option implied volatility is, that what the market makers are using. $4.63 move. They think this stock's going to move $4.50 over earnings. Well, between now and Friday, and earnings are on, I think, Thursday, right? Yeah. So we're 14, 15, 16, 17, but earnings are on 16. Oh, earnings are on Wednesday. Is that right? Yeah. Earnings are in 2 days. So if you're going to hold through to earnings, then they're looking for like a $5 move on earnings. $5? Yeah, $5 move. All right, so that's pretty easy. We're at 93-ish right now. $5 is 88. So as long as you were selling something outside of $5, you've got a better than 70% chance it's never even going to get there. So for 88, I could sell a 65-cent credit, and then I could protect myself with something further out of the money. Say, I just said there's 80 clear down here for 15 cents. That's not terrible, but probably the 85 is better, 30. So I would sell the 88 and buy the 85 and have a 35-cent credit, right? So buy the 35. Oh, do that. Well, that's vertical. Let me go back to single so I can see the prices, and then I can adjust these to be whatever I want. So I want to buy the 85 and I want to sell the 88. And this is for this Friday. Yeah. Is that right? I think that's right. Okay. So buy the 85 put, sell that one, and I get a 42-cent credit for this. Correct. I think that's right. I think I've got everything right. So anyway, in this situation, I would be selling this thing and I would collect a 42-cent credit. As long as the trade stayed above 88, then and there's better than 70% chance that it will, even with the earnings drop, then I would make the 42-cent credit. If I did not, if it went all the way to 85, $3 minus 42 cents, that's how much I could lose. So the maximum amount I could lose would be 3 minus 42, $2.58. So this is a risk $2.58 to make 42 cents. In fact, with that number, I realized the probabilities are much higher than 70%. They're more like, um, what's that going to be? That's higher than 80%. It's like an 81% probability. At least that's how it's priced. It's priced to win 81% of the time. I think it's even higher than that because 81% would be break even in terms of probability. Um, and I think it's a little higher. So I think you probably got like an 85% chance of winning that. Um, because, well, let me show you the biggest reason why that's going to be true. So, if you're selling options and you want to try to collect credit, you like the idea that the option prices are high and going to drop. Look down here at my implied volatility study. We see the option prices are higher than typical, right? They tend to run low. Right now, they're way up here. They're high, and when earnings happen, that's that's what happens. Prices all collapse to lower amounts. So, so I think this is a really good trade setup. I also love the idea that it's true lumber could be coming down, but somewhere along the way, it's gonna rebound a little bit, right? It comes down, it goes up, comes down, comes up. If it goes back up, well, then this thing is the same thing. It's going to drop, but it's going to come back up. So I'll have a little bit of buoyancy, and I like the idea that it could kind of hold itself above this level. Now the line down here is actually clear down at 87. So if we wanted to be a little bit more conservative, then maybe changing this to an 87 put, still picking up 22 cents credit, but that's now a hey, risk 20 or risk a dollar 78 to make 22 cents. You will definitely win, have a 90% chance of winning that. But when you lose, you lose a lot. So all right, now we got a question here. I'm going to try and get back to where my screen is so I can see the chat. There we go. Helen, how you doing, Helen? Hi, Gordon. How interesting about lumber and Home Depot and gold. Good. Curious what you think of the markets this week. Well, I think that they're going to drift higher a little bit. In fact, though, yeah, I'm doing well too. I think that they're going to drift a little higher. And one of the reasons I do is I've just got a few more minutes left here. And so I'm going to end it up with this. I put out on my trading view, I throw out ideas every now and again, and um, I don't, I'm not super uh, active, should I say? I've been thinking about maybe trying to do this more frequently, but whatever. Just last week, I put out a bunch of ideas, and I was just sort of randomly throwing them out there. Wasn't expecting anything, and all of a sudden, I got these comments back, which I'll usually get one comment. This one, however, I got several comments back. I was really surprised. I shouldn't have been. It's GameStop, right? GameStop, this is the whole saga. They were low, they went running way up, they came back down. Now it's all about that, hey, it's a short squeeze, and we, the Wall Street Bet readers, that we're gonna get those stupid Melvin hedge fund guys, and we're gonna squeeze them. And so, yeah, it's a religion on Wall Street Bets. It is just a religion nowadays. They just have all sorts of reasons to have faith. The new date is July. By July, they're going to be squeezed out. GameStop to 400. So there's one particular problem with the thesis. The original thesis, the Roaring Kitty guy, that he's kind of the most famous dude on Wall Street Bets, for this reason, is that he got in early on GameStop. The original idea was that he was following Michael Burry's analysis, and he dug a little deeper, and he said, this is really a good stock. It shouldn't be getting shorted clear down to 10 or $20, or somewhere in that level or lower. That company's not going away. Yeah, their stores aren't the flashiest, but there's all sorts of things that the board could do to make lots of money, and it's a better company than it seems. It's certainly not going negative like all these guys who are trying to naked short it seem to think it is. All right, so that was the original thesis. Okay, so maybe it is worth more than $20 a share, but it's not worth $200. It's not 10 times more valuable than it was being undervalued, unless somehow the guys at GameStop, the board, the management company, the people behind it, have this incredibly profitable strategy where they're just gonna, I don't know, maybe they're gonna buy Twitch, maybe they're going to take a equity interest in Activision or Blizzard or whatever, right? I mean, I don't know, unless they had some huge bold new move that they were going to make a ton of money with, and people were going to say, wow, that's going to make a ton of money, I'm going to buy their stock, right? Unless that were to happen, then $200 a share is overvalued, let alone 400, let alone 69,200, the theoretical number that some Wall Street Bet memer came up with, right? So, sorry, 200's more expensive than the stock should be. Yeah, $20 cheaper than the stock should be, but 200 is more expensive. But it's all relative, right? If everybody says, well, I don't care how much it's worth, I just want to own GME stock. I like the idea. Going to own GME stock. Going to do it. Going to buy it. Never going to sell. Fine. You want to play the game that way? Your money. So that's the problem. We just don't know. If somebody buys 200 and 1,000 more people come in and say, I want to buy 210 or 20 or 300, then the guy who bought it at 200, doesn't matter that stock should have been lower in price. He still makes money, 50% on his investment, right? That's the nature of stocks. That's the nature of just people's beliefs about something. That's the nature of the whole cryptocurrency market right now, right? Cryptocurrency hasn't proved itself. It is super interesting technology. I love its possibility. I want it to bring about a new future in the world, but it hasn't done it yet, and it might be outrageously overvalued right now. It might be. So how do you know? Well, I don't. But in my case, I'm sitting here looking at GME stock, and I'm seeing that level right there. It jumps up and it drops down. Somebody jumped in on one of the comments like, yeah, that's because the company sold 5 million shares. Are you kidding me? Are you trying to tell me that the company sold 5 million of its own shares between 280 and 222? It sold down 60. That's $60 on 280 is 30%. The company sold down 30% of its value by getting rid of 5 million shares. What company would do that? If in fact that is true, I doubt it. But if in fact that price dropped because the company unloaded 5 million shares in the market and gave up 30% of their own value, because these company own their own stock, right? The only reason is because they don't think it's worth $300 a share. Is because they think they can do more with that money that they're going to get by selling the stock than they can by holding it in there. And this is GameStop we're talking about. This is a company that let their stores languish. You ever go into a GameStop store? I haven't been in a GameStop store for a couple of years, but the last time I went in a GameStop store, it was just like this mess of game cartridges all over the place. It's always kind of crowded in there. The guy standing at the counter is like, dude, give me a second, okay? And then the biggest money that I could see in the store was used games. People come in, I want to sell this back and buy that used game, right? It's a little horse trading thing that kind of goes on. That's really smart. The GameStop did that, but it's so organic. It's like literally trading baseball cards. You've got no idea. They're just gonna, buy, sell, or, I mean, sell high, buy low, so to speak, and make money on the turnaround. And the user's like, ah, fine. But if there's any actually good margin there, then somebody's going to do that online and cut into their margin. That's not a sustainable business. And if that's all you got, you don't got much. Strip malls, the locations, these terrible locations, just terrible value for these real estate. So I look at this company and I think this is not people being on the leading curve, figuring out cool ways to provide great services to their customers and uh, and innovate things, making it attractive, make you want. No, this is a company that's getting dang lucky by just hanging around because there aren't that many people that are selling physical video games. They just happen to hang in there. It's kind of a cash cow business that makes some money, and the corporation management is like, it's good enough. That's it. That company's not going to innovate into $1,000 share worth of value, and they know it. That's why they're going to dump 5 million shares and lose 30% of their value. So my thesis was that's resistance. There are new short sellers that are going to come in, people who are really looking for a quick hit. There's all those that said, buy this, short squeeze, yay. But there's even more people out there now who look at this $300 down to $46. I want a piece of that action. I want to go that way. I want to make, $250 a share in a week and a half. And I can do it by going down. Well, you can get this too on the way back up, but I mean, that's lightning strike once. Hey, and it struck again. Not so much here. I mean, yes, this is still a good move. 150 up to 300. I mean, I bought some of this stock, not a lot. Here, sold it up there, bought it here, sold it up there again. So I get that. I totally get that. But notice that opportunity is decreasing. It's possible that this thing's going to run up again, but what I think is going to happen is that people see this opportunity for the short, and they're going to try and jump in. Now, you and me and retail buyers, we don't short GameStop, but I know who does. Proprietary prop shop traders all around the world, particularly those in the United States, they got a lot of money, they got a lot of capital to work with. Shorting they can do in less than a blink of an eye. It's their systems are set up for that. And those guys, they go in there like, I can short 1,000 shares of GameStop, and I can buy it back 20 seconds later, $1 cheaper. That's $1,000 I made inside of a minute. I'm going to try and do that all day long. Or even better, they'll sell 1,000. They're not losing money. 5 minutes later, they'll sell another 1,000. Oh, look, it's not coming against me. I think I'll add in another 1,000, another 1,000. There'll be 4,000 into it. They'll wait. It drops $4 or $10 a share, and then they hurry and buy it back. $40,000 inside of a half an hour. That's what those guys are trying to do, and they're just waiting to pounce and throw in That's who is going to be shorting GameStop. So I think that's really going to be interesting to see who's going to win. Is the Wall Street bettors? They're going to like, I'm going to go in here and buy GameStop, and I'm going to hold on. Or those prop shop guys that are like, I'm going to sell it as soon as I get the opportunity to. We shall see. I believe that if that lumber gold ratio is telling us speculators are backing off from the market, then GameStop, more so than cryptocurrency and Bitcoin, GameStop is likely to be the one that gets hit the hardest, because GameStop is a pure speculation play at this price, not a long-term buy and hold. All right, so how is the market opening up? Let's get a look here. Well, I'll bring it up right here instead of GameStop. So we opened up with a little jump, but we've been selling. Let's look at the 5-minute chart. Oh wow, look at that. So it opened and then just started selling straight into the day. If you're a buyer, that's fantastic news because you're going to want to see this thing sell, and then you're going to try and pick up some shares. If you are of the opinion that people are done speculating, well, then that move right there is kind of proof, right? These are all these people that wanted to get out because they were just waiting for a good price, and it opened up at the high price, so they attacked it. They just started selling. You got to admit that's a pretty big bar for just coming out. All of this is Friday's action, right? So this is the last week. I'm trying to remember. I think that's is that the Fed announcement? I can't remember what activity that was, or was this the 11th? This was Friday. No, that wasn't non-farm. Non-farm payroll was the week before, so this was Thursday. I can't remember the news action that was last week, but as you can see, that ran up and then they gave it all back, and then it's come up since then. None of these bars were anything like those sizes. This bar that we're looking at now is like those sizes. So this is an unusually big bar right now, and my guess is that wherever it goes is going to be too much. So at some point we're going to be buying and buying it back up. That would be my guess. Um, Real quick, May 14th, Doomsday didn't happen, right? Could it still happen? It could, but I'm not one who tries to play the game. Yeah, I was just late. Early. I was just early. It came late. My prediction was that people were going to be in the mood to sell in May, and I think they were. We saw that, but they didn't sell a lot, and I think there were reasons for that. That is the idea that they're going to change the tax code. It's like you're not going to get any incentive for selling after a year. You're going to have to pay a high tax. The only way you can avoid paying the high tax is not to sell. So I think that kind of played in part of it. The other part of it is that people were still looking to try to find good buys. They're still out there trying to find a good place to speculate, and tech was already low priced. That kind of already sold off in March. So those are a couple of the reasons. And the other is the U.S. government's creating $8 trillion new in budget, and the Fed is out there not raising interest rates. So money is just coming into the market. It's like crazy, and people feel like, I don't want to sell now. Could it be that they do want to sell come June? It could be. It could be that it's just going to come later, but that is a different dynamic. In fact, if we use the 56-week pattern, we can find what are the new times that are going to be the new vulnerabilities coming up. I'm going to be looking at that in the next couple of weeks ahead. But until I get to that point, I'm just going to say, Hey, I was glad that I had at least one trade, the Apple and the IWM trade that I had shown here earlier, that were able to make me some money even though I was wrong. And that's what you're trying to do is look for those trades that have the ability to pay you even if you go wrong. And I hope the H&R Block and the Lennar trades give you some idea of how to think about ways you do that, at least with options. In the world of stocks where you're just buying shares, like I don't do options, just shares. I want to buy low, I want to sell high. Where's that trade, Gordon? How do I get that? Well, I mean, you have to be prepared to be wrong with those kinds of trades. Here's one, Quidian. It's a $2.15 stock, but look how high it's been, 375, as low as 120. So this thing moves all over the place, right? So this is a nice low price stock and is about to hit earnings tomorrow. And so this thing could move, right? So what would you do with a stock like this? If I bought it and I was wrong, how could I make money? Okay, real quick idea. Sorry, I'm so late in the hour here, but just I'll talk more about this in the days to come. You buy a stock with only you pre-plan the purchase. You say, I'm going to use a certain amount of capital. Let's say $1,000. I'm going to use $1,000 to make this trade with. So I'm going to buy some of it today, not all of it. I'm going to put in, let's say, $350. And I'm going to do that right before earnings. Now, if I'm right and it runs up, well, at least I made it with 350, and then I'll add, some more as I decide I want to continue going. If in fact I do want to do that. But the big thing is I want to be able to do something if I'm wrong. What if I buy this and it drops to $1.67, $1.50, somewhere in there a share? Great. That's where I got the rest of my money. At $650, I'm going to put in 300 at a time or something. I'm going to buy it as it gets lower. If I do that all at once and then I say, oh, it went lower, but I still think it's going to go up, I'm going to double down. I'm just increasing my risk. If instead I say, I have that much to risk and I'm going to just be judicious about how I get into it, then now all of a sudden I can be wrong and still be right. If I buy this thing here and I'm wrong, and it drops to 167, and I add $600 worth of shares down here, and it comes back up just halfway. I could sell at that point for a profit. Is that interesting? I could lose 30 cents from my initial purchase, but still be making money on the trade. As long as I have that as part of the plan, I have the ability to be wrong and still profit. On the other hand, if I'm right and it takes off, I make good money. It's really important to find ways to set up trades like that over time. All right. Let's see. Oh, yeah. So Helen's got some great comments. I was told bond market was larger than currency market. Is that so in dollar value? Hey, real interesting question about what's bigger, bonds or Forex. The reason the Forex market is the biggest is because you are trading with dollars, right? So it's like if I go and I put in $500 in a euro dollar trade, but I'm leveraging that 50 to 1, right? Then now that's actually $25,000 that I'm moving around in the market or controlling. So that I've made a trade now worth $30,000 or that has $30,000 connected to it. And so when you count up what's being traded in the Forex market, you're not counting my $500, you're counting the $30,000. And so when they count all of that stuff all over the place, then the number gets really big. And that's why people say, oh, Forex is the biggest market. Bond market is similar in the sense that, you make a loan out there and then there's a bunch of other stuff attached to it, but they don't count all the other stuff. They just count what you put into it. So in reality, the bond market, the amount of money that goes in, that comes out of people's pockets and goes into the money is probably bigger in the bond market. But does that mean that there's more opportunity and you can get more out of it. No, 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 no. The bond market is far less liquid than the forex market, and you can't leverage. You can leverage the bond market, but it's just not as easy to. It takes more money and so forth. So um, yeah, we'll see. Got a cold. Hopefully not a vaccine reaction. Nope, it's not a vax reaction. Um, that's all I'll say about that. So, are the U.S. Dollars economic numbers true on the ground? Do you see business improvements? Oh, without a doubt, without a doubt. What I'm seeing here in the U.S. is people opening up. I mean, the state that I live in the United States is Utah. The unemployment rate here is only 2.5%. 2.5%. People who want to try to hire workers are having the worst time trying to find somebody to come take their work. They just and freelancers, it's never been a better time to be a freelance right now. I'm just amazed. If you want to work out there, in Utah for sure, but really anywhere in the United States, if you want to work, you get work. And so, yeah, things are economically looking really well, yeah, and a very, very bright future in the U.S., I believe. Um, what about the new Game Stoppers? People coming in. Yeah, yeah, that's going to be interesting. Will new buyers of GameStop drive the price even higher and keep it going? They may. I think people getting into GameStop at this point, though, they don't really know what they're doing. They don't have this "I want to own GameStop forever" kind of mentality. I think they're like, "I'll buy if it's going up. Oh, it's going down. Ah, get me out of here." I think that's the way they're going to behave, right? That's why I think the shorts have a better chance at it right now, um, with GameStop. All right, well, there. Sorry, I went a little long this time around, but I had a lot to say. Hope you enjoyed it. Hope you got some use out of that. Come back next week. I'm going to do more of these QD kinds of trades and give you some idea of how you can work with low price stocks to be wrong and yet still be right. Until next week, take care and trade well.